You can give an intro or something, Dennis.
Okay, well, good morning, everyone. My name is Dennis, aka Stock Operator. We want to talk today about options. We have an awesome presenter, Zen. She's a member of our community. So, Zen, the floor is yours.
Yeah. Thank you, guys. Rapid will set start. But Dennis, thank you guys for running the Discord group. I know you guys put in a lot of effort, so I appreciate having this group. And today, let's just get started. There is enough content, so let's go ahead and get started. Again, to start with the usual disclaimer. This is not any investment advice. This is not advice for you to jump it into options. This is all for educational purposes. So the routine disclaimer that you guys will see in any environment, stock trading environment. Having given the disclaimer, let's jump in. So this slide just tells you what the goals are with this session. This is a basic introductory session, so we're just going to understand the basics. You can go pretty deep into options, but there are certain basic concepts that you need to just get into your head just to get started and get the ball rolling. So the goal for this presentation is just to go over that part, just get our basics under our belt, and then we can start exploring. So we will understand the basics, what an option is, how to understand an option chain. I'm going to give a screenshot of an option chain so that we can understand the pieces. And then what are the basic building blocks? So there are so many advanced, if you go to any options website or any options information, then you will see very fancy terms. They will say jade lizard, big lizard, iron condor. So I think it's the fancy terminology that puts us all off. You're like, okay, this is some geek world that we cannot enter into. So we're going to put all that aside and we're just going to understand the basic building blocks. What's a call? What's a put? What's buying premium? What's selling premium? And what are the Greeks? So once we start talking Greeks again, we find that it's kind of in nerd territory, but that's okay. We'll just going to go in introduction. We're not going to do a deep dive, but we'll just talk about them because they are essential for understanding options. So again, the last part in this slide is what I thought when I was putting together is we'll just get the basics under the belt. And I know a lot of us in this community are already trading, right? So we are buying and selling stocks, we are doing swing trading, day trading. So how we can think of what we are doing today, just simple trading stocks and combining options. So that was kind of what my thought is, like, how can we get started right now, like with what we do today, swing trading or day trading? So that is my goal. Keep it pretty simple, get the basics down. So next let's jump into basics. So and options, one of the things I left out is an option is a derivative, right? An option is a derivative. That is one thing we should get down. So what is a derivative? A derivative is something that's derived or obtained from something else. So what are options derived from?
Zen, I'll interrupt you real quick. Can you add a few people, please? You're waiting in the room.
Dennis, did you say something?
Yeah. Can you add a few people, please? They're waiting in the room.
I can't hear you, Dennis.
Can you hear me now? Can you add a few people? They're waiting in the room.
Oh, okay. Got you.
Hey, babe.
I don't see where they're waiting. Let me see. Okay, there is one. All right. I hit admit all, so everybody should be in.
Yeah, I do.
Thank you very much.
In the middle of the classroom right now.
So so an option is derivative, and because it's called a derivative because it is derived from the underlying stock. That's why it's called a derivative. And one thing that you need to remember is one options contract has an association with 100 shares. So this fact should always be in your mind when you're buying and selling options. You should always remember that one contract is worth 100 shares. Okay, so when you are buying an option, let's first talk in terms of buying. We will talk about selling in a little bit, but first let's talk about just buying. So when you are buying an option, you are buying a right. You are paying for a right associated with 100 shares. For example, when you're buying a call option, you're saying, hey, I am putting this a down payment. It's like a down payment to a house or an advance or a deposit, right? So you go in and say, okay, I'm going to buy this house for 200K, but to reserve that right, I'm going to put $10,000 down today. And I'm going to buy this house from you within 3 months. That's the kind of real estate deal you do, right? It's a very similar. So, for example, look at the option chain that I have highlighted here. So this is AMD, and this is January 22. This is January 22 right here. So you're saying, let you look at this price. We are going to go into the details on what this whole table means piece by piece in the upcoming slide. But I'm just to give you an example, just $88.5 is the call option is worth $1.95. Again, everything you multiply by 100. So $1.95 here means you're paying $195. So you go and give someone, the option seller, don't worry about who the other party is. It can be a market maker, a broker, an option seller. Don't worry about the other party. You are paying $195 today to say, hey, at any time between today and January 22nd, which is here, right? You see the date here. I can come and buy 100 shares of AMD at $88.50. To reserve that right, you have to pay from your pocket $195 today. Okay, so that's what this means. So an option is you're paying for the right to exercise at a fixed price. Okay, so since we are keeping it pretty basic and fundamental, we are thinking just as a layman, let's not get fancy. Who determines, like, who says I have to pay the $195, right? Can I give $100? Can I give $50? Why are you not charging me $500, right? So where does this $195 come from? Option prices are derived from mathematical models that is agreed upon by brokers, market makers across the board. They run mathematical models like the Black-Scholes model, and the option prices depend on several factors. Depending on the underlying price, which is the price of AMD right now, the strike price, you want to buy it at 88.5, expiration, you want time till January 22nd, and also how volatile AMD stock is. So without going into much detail, the option prices are derived from mathematical models. They are standard across the board, across brokers. So you go to TD, Tastyworks, you go to IB, everything should be the same. Everybody prices the same. So, and so there are, if you look at, for example, I put a contrasting example in March, right? So you look at the March prices of calls. It's $695, right? So when you're doing more and more options, you won't say $695 anymore. You will say $6.95. So if I want to buy, the strikes are slightly different, but let us look at 89 versus 90, right? If you want to buy the January 22nd expiration for $89, you're going to pay $1.75. But if you want to buy a March expiration, this is the middle of March because options always expire in the middle of the month. So if you want to buy a 90 call for AMD, you got to pay $6.95, which is basically $695. So see the difference in the amount you're paying, right? $175 versus $695, which is huge, which is significantly different. And the difference is because you have the luxury of time on your side when you're buying a March call, right? So this $175 is a January 22nd call, but a March call is you are 2 months out, 2.5 months out from now, from today, right? So within that, AMD can become $150, right? But you have or want to reserve your right to buy AMD at 90. So you're paying more for the luxury of time, for the extended time. So this is the basic concepts so far, like the very fundamental of you are paying for the right to buy. Let's now stick with buy. There is also selling, which will come later. Right to buy within a certain period of time at a certain price. Again, ask me any questions. If anywhere I'm not clear, I'll be happy to answer. Okay. Then you can buy and also you can sell. Again, I know all of us are traders here. So just like you can go long and short shares, you can also go long and short options. You can buy options and also you can sell options. Okay, we will talk about it a little bit detail a little further. So I'm going to kind of run through in the interest of time, but feel free to ask questions. So now let's talk a little bit about the option chain. Visually, we will look at the option chain. We talked about the underlying. So for the prior example, AMD was the underlying. There's a strike price. There's an expiration date. There is a bid and ask, just like we have for shares. There's a put side versus call side. So this one we need to understand a little better. There is liquidity and volatility, and there is weekly versus monthly options. So let me jump into the next slide so that we can look at it in the option chain. Again, this particular broker, if you guys are wondering, I have never seen something like this before. This particular broker is a broker called Tasty Words. But all the brokers, any broker, you can look at it. You can look at it in TOS. You can look at it in IB. The fundamental structure is the same. Visually, it might look different. Okay. So again, this is the underlying. Remember, an option is a derivative, so it has to have an underlying. So space is your underlying, right? So this whole thing is called your option chain. And here you have your strike. Here you have expirations. You see this? These dates are expirations. So this particular expiration that I have expanded out is January 15th expiration. Again, that was Friday, but I did this earlier. So it shows the January 15th expiration, right? So it shows how many days are left for any specific expiration. And then you see this is the call side of the option chain. This is the put side of the option chain. We're going to talk about it, okay? And then see, just like for shares, we have bid and ask on both sides, on the call side as well as the put side. And then I'm going to briefly touch upon volatility and liquidity, right? I'm not going to talk in detail because it will come further, but this open interest is how many people are actually, how many options are actually traded at that price point. It's a measure of liquidity. And there is something called IVX, which is called Implied Volatility rank. Again, more of to come later, but this is a measure of volatility. So these are two important concepts when it comes to options, liquidity and volatility. But this is the basic option chain with the underlying expirations, strikes, and your bid and asks. Okay. Then let's move on to understanding the building blocks. Okay. The put versus call, going long versus short, and buying versus selling premium. So what is the call? What is the put? Because you hear that all the time when you're hearing about options, right? Let us say you're long on a stock. You think AMD is going to go to $120, right? Then you will buy a call. When you're bullish, you will buy a call. So in the previous example, for example, here, if I am buying it for March 90 call, if I am willing to pay $695, I'm willing to fork $695 out of my pocket for a right to buy AMD at 90, then I'm bullish because I'm paying out of my pocket, right? So if AMD becomes $120 by then, whoever sold me that owes me AMD shares at $90. So I can buy AMD at 90, I can turn back and sell it right at 120, or I can hold whatever I want. But on that day, AMD, let us say on March 1st or February 25th, AMD hits 150, I have the right to buy AMD at 90 because I have paid out of my pocket, okay? So when you're bullish, you buy a call, right? Then you can also, if you're bullish, sell a put. Okay, what is a put? A put is, let us say I am thinking, let's go back to the same example. I don't believe now Intel has a new CEO. I don't believe AMD is going to go anymore because Intel is going to wake up, and I think that AMD is going to crash to 80, right? But I'm not sure. Let us say I'm holding 1,000 shares of AMD right now. I bought it at $50. Right now I'm happy because it's about 85. But what happens if it dumps? I want to save my profits at 80 bucks. I'm like, I need at least 30 bucks out of my $50 investment. So I want to cap my downside from where it is right now. So what I'll do is I go and buy a put. So here you see the put cost $3.65. So I'm willing to pay $365 today to get a minimum price of AMD. Okay, so then let's go back to the table. So in this case, when you are bearish, right, you buy a put, right? So we have just talked about only these two cases, right? We have talked about buying a call and buying a put. So if you're bullish, you are buying call. If you're bearish, you're buying a put. So for the time being, at least you can you remember that you can do the flip. So when you're bullish, you can buy a call or you can sell a put. This part is buying premium. Buying a call is buying premium, and the sell put is selling a premium. Okay, and when you're bearish, you can buy a put, right? Buy put, or you can flip it and you can sell a call. This is selling premium. So this goes back to next slide, goes to the next slide, buying versus selling premium. Okay, this gets a little confusing at this point, right? What is selling premium? What do you mean? I understand buying a call, I understand buying a put. I pay $200, $500, whatever it is, I buy a call because I'm bullish. I think it's going to go up. Okay, or I pay $500 because I think it's going to go down. So I'm bearish and bullish. That is pretty straightforward. But when you say I'm going to sell premium, it gets a little confusing. But let's look at a couple of examples, and then it'll get much clearer. So for Baba, for example, these are real screenshots from Tastyworks. Again, different brokers visually look different, but the concept is the same. So here we have a January 15th Baba call, right? 220 call. And remember, because we are buying, we have to pay out of pocket. So I pay $10.73, which is, how much is that? Times 100, so $1,073. So $1,073 out of pocket, right? So this is from the past. January 15th is already gone, but this is a buy call example. So where we pay out of pocket. So again, another example, AVTR, 2 calls, each call cost me $47. So $98 investment, and it is valid till January 30. Okay, so January 15. So now, just to give you an example here on the side, because January 15th is gone, Baba was at 232 on January 15th. So there are 2 things you can do. You can sell back the call for a profit, or you can buy Baba at 220. So here you see a 100 share assignment of Baba at $220. Okay. We will, in the next slide, we will talk about the concept of a break even. Let's not go into that right now. But this is an example, two examples of buy call and what happens when you buy a call, right? So this is what happens. What is the possibility? Okay. So basically, you are assured, because if you look at the trade price here, it will be 220. You are assured that you will be given 100 shares of Baba at 220 because you are willing to pay for it. Okay. Then the next example is selling premium. So let us look at just the first example, NVAX, right? You see -1 here. For example, you see in these two examples, you see +1 and +2. That means those are buys, right? If you see a negative number, those are sells. So what I did was, remember, any transaction has two parties, a buyer and a seller, right? When I bought a Baba call here for $1,000, somebody actually took that money from me, right? I paid someone $1,000. It went to somebody else's pocket. It moved from my pocket to their pocket, right? So this transaction on NVAX at the bottom is the opposite of that, right? So 100 put, I am selling 100 put. So somebody is buying. Somebody wants to protect their NVAX investment, right? Somebody wants at least $100 for their NVAX shares. So they are willing to pay me $18.25, which is $1,825, right? $18.25. They are willing to pay me. So I am saying, okay, I will take the risk. If NVAX goes to $80, I will take that loss. But for me to take that risk, you have to pay me some money, right? Just like I paid somebody for Baba $1,000 or whatever the dollar does not matter. It can be. So just like I was willing to pay somebody, somebody is willing to pay me to save their investment on the downside. So I am taking that premium and I'm putting it in my pocket right off the bat. It's like shorting shares, right? So right off the bat, I'm taking that premium. Why am I taking it? As a premium seller, I expect that the price will go down and I can buy it back for cheaper. The same concept with shorting a regular share that we do every day, right? We short high and we expect that we can buy it back at a lower price and we keep the profit. It's the same concept here. So I'm shorting here at a certain price and I'm expecting that over time that price will go down and I can buy it back cheaper and I can pocket the profit. So this is another example. So PLTR, again, one contract, I sold a put and somebody was willing to pay me $5 because I don't know where they bought it, but they want to protect their investment at 29 bucks. So they're willing to pay me $5 for their investment. Okay. So what happened here? Again, I just want to show you what can happen as a consequence. We are going to talk about the terminology in the next slides, but what can happen as a consequence, right? 29 was my strike price. If you remember this slide, these are the strike prices, right? So 29 was my strike price on January 15th. PLTR, as we all know, because we have been trading PLTR. PLTR was below 29, right? So I received $5 for the risk of taking PLTR below $29, and it so happened that it came true. If PLTR was $35, PLTR was $50, what would happen? I'll just keep these $5. I already put it in my pocket. It'll remain in my pocket. I'm happy. $500 done. But what happened? PLTR was below 29 on January 15th, the strike date. So somebody came and turned in and said, hey, you promised us that you will take 100 shares of PLTR at $29. And you got paid for that risk, right? So I was assigned, this is called an assignment, I was assigned 100 shares of PLTR. So now I own 100 shares of PLTR, which was assigned to me at $29. But my break even is actually 24. We will talk about that in the next slide, okay? So these are two examples of what can happen when you buy a call or when you sell, buy premium or sell premium. All right, next one, next slide. The same buying versus selling premium. I want to quickly talk about the concept of break even. Again, a lot of materials available online on YouTube with payoff diagrams. So you can look at payoff diagrams. Simple Google search will reveal you all kinds of payoff diagrams for buying a call, buying a put, selling a call, and selling a put. But I just want to throw in very quick example of what break even you can keep in mind, break even calculations. Again, I'm not going to detail into all the payoff diagrams. There is tons of payoff diagrams out there. You can look at it. All the content, all the material is available by searches, but I just want to kind of quickly touch on the concept of break even. So I use the same examples of and this is the prior slide, right? BABA. So I got a strike 220 call, but I paid $10, right? I paid out of my pocket. So when am I going to make profit? What's my break even? I have to add the 220 plus the 1073. So my break even is actually $230.73. So I am profitable in BABA only if BABA is higher than the 230.73, right? Same concept with the AVTR. 30 strike, I paid 47 cents. So I am break even only if it's above 30.47. Below that, I'm not. I'm at a loss, right? Then selling premium. Okay, what is the break even of selling premium? NVAX, my strike is 100, but I collected. We use the word collected. For premium buying, we say paid, but for premium selling, we say collected. But I collected $18.25, right? So my break even is $100 minus $18.25, $81.75. If NVAX goes below $81.75, then I'm looking at a loss. But as long as it stays above $81.75 on the date of expiration, I'm okay. I'm making money on this deal. Same with PLTR, right? 29 minus 5, my break even is 24, right? So PLTR, if you look at the last price in this snapshot, it was 23.55. So if it's 23.55, I'm at a loss. Okay, that is the concept of break even, and this is something you should keep in mind always when you're buying and selling premium. Then moving on to some terminology, right? Now we are getting into some fancy terminology. We are getting into I think I have my mine's on. That's okay. So we are getting into words like exercise, assignment, and also if you listen to any of the options presentations, you will hear at the money, out the money, in the money. Yeah. Then other two terms are intrinsic value, extrinsic value, actual volatility, implied volatility rank. Again, lots of terms are going to be thrown in, but as long as you understand some of the basics, you can kind of go from there. So we talked about exercise and assignment briefly here, right? So in this case, I bought a call, right? And I had the right. So I exercised my call. I said, hey, Baba is 232, but I have a right at 220. So I exercised, right? But in this case, in PLTR, I was assigned because somebody else exercised. They said, hey, I have bought the right to sell PLTR at 29, and I'm going to exercise that right. So I got assigned. Somebody else exercised, I got assigned. So here, Baba, I exercised, somebody else got assigned. In PLTR, I got assigned, right? So that goes back to these two words, exercise and assignment. Okay, then we'll go to at the money, in the money, and out the money. We'll go back to our options chain. That is an easy way to see. So if you look at, I know the font is a little bit small here, but if you see, you will see ITM here, right? So one thing you can remember is wherever the stock price is at, that's at the money. And calls whatever values the stock price is below the current price, those are all in the money calls. So for example, in this example, SPCE current stock price, last price is 23.73. So if you take a 22 strike call, right, the stock price is already above the 22, right? This 22 strike is in the money for a call, right? But the puts, it's the opposite, right? So if 24, if you, let's say 24.5, then a stock price of 23.73 is already below 24.5. So all this sections, remember, this is the put section of the chain. So all this above is in the money. For a call, all the strike prices below the current stock price is in the money. Okay, that's what they mean when they say out the money, at the money, or in the money. Okay. Then there is intrinsic and extrinsic value. And I'm not going to talk in detail about this. I'm just going to talk about, because there is this content, we need to finish the content. So let me just give a quick verbal example and we can go from there. So for example, let us say the current stock price is 20, right? And the 22 strike is $2.50. Okay. So current stock price is $20 and a certain options price is $2.50. The strike 22 strike. So what's the actual difference between 22 and 20? It's only $2, right? So that $2 is the intrinsic value because that's the actual stock price difference. But the options cost is $2.50. What is that extra 50 cents? That is what is called the extrinsic value. That is the extra you have to pay for that time period. You understand what I'm saying? So let us say that 20 to 50 call is 30 days out. So for the privilege of reserving that stock price for the next 30 days, you are paying that extra 50 cents. That extra 50 cents is what is called the extrinsic value. Again, we can talk about it as we go further as it comes, but that's kind of the basic idea. The actual difference between the strike price and the stock price is intrinsic value, because that is actually how the values differ, and anything above the intrinsic value is called the extrinsic value. Okay. Then there is actual volatility. This is a very important concept. We will be, again, very at a high level. We know that volatility touches the options prices. For example, let me give you a very high example. Something like Tesla is humongously volatile compared to, let us say, 80/80 stock, right? 80/80 stock barely moves. If 80/80 stock moves $2, it's a big deal. It moves probably 50 cents in a day. But we know that Tesla easily moves 15 bucks, 40 bucks, 80 bucks, right? So that's because Tesla is more volatile. The higher the volatility, the higher the option prices, which actually makes a good segue into the next slide. We can come back. I think we talked about in the money, out the money on the side, current price. So let's go on to the next slide. So, okay. In the money, at the money, and out the money, it all comes down to probabilities and time value. Again, we talked about how option prices are derived from mathematical models. Again, here, all this looks very geeky, nerdy, and scary, but we don't have to really go deep into this. We just need to understand some of the basics, right? So this is the standard deviation curve. Again, if you are have a mathematics background, should be very familiar. But even if you don't have a mathematics background, this is not rocket science. So what it says is this is the distribution of the probabilities. So for example, let us talk in terms of stocks. So let us talk in terms of, well, let's start in terms of Tesla, because that's always fine. So let us say Tesla stock price is here, right? So this is the current price. This is the current price, right? And this, let us say this is 1 month expiration. It can be 1 month, it can be 3 months. For any period, you can draw the normal distribution curve. So there is a 34.1% chance that it will go up 1 standard deviation. See the 34.1%? There is a 34.1% chance that it will go to the standard 1 standard deviation to the downside, right? So this whole 1 standard deviation, 1 standard deviation, 2 standard deviation, this whole thing accounts for 95.4% of the possibility of the move. Is there a chance it will go right here? Yes, there is. But the probabilities, we're all talking probabilities here, right? The probability that it will go here to this end is much, much lower when it is compared to the probability of going here. So for example, let's look at this curve. This is an actual trade I have in Apple, right? So this is, look at the expiration, 34-day expiration. Look at this curve here. So this is the same normal distribution curve, right? So this is just a theoretical curve drawn somewhere. This is actually a curve of an underlying, which is Apple, 34 days expiration, and I have a trade in it. So I thought it will be a good example, right? So you have, this is where the Apple price is like about 130 bucks. So this circle is the current price. So in this expiration date, what are the chances? Where are the higher R's? Will it get till 140? Yeah, this is your 1 standard deviation line. This is your 2 standard deviation line. So this gives you a 3rd standard deviation line. So I have calls that I have bought sitting right here. So they are sitting between the 1 standard deviation line and the 2 standard deviation line. So the probability, is it highly probable? Not. Is it impossible? Not. It's kind of halfway, right? So this is what options. So this whole range is about, what is the probability of that? 95.4% chance that the price will go. Is there a chance it will go to 80? Yeah, there is a little bit of chance. Is there a chance that it will go to 110? There is a very high chance it can go to 110, right? So all we are doing with options is we are trying to come up with a price range within a certain time. And this normal distribution curve gives you an idea of how feasible it is, right? And then going back to Tesla, right? This higher the volatility, the wider the probability distribution graph. So compare the graphs of Apple versus Tesla. We know that by trading, we know that Tesla is very volatile. But look at the range for Apple versus range for Tesla, right? Look in the curve, look at this end of Apple is 80, this end of Apple is 180. But look at Tesla, this end is 400, but actual range is within 1 standard deviation is here, but this is 400 and this is about 1,400, right? So the higher the volatility, the wider the probability distribution graph. So for example, Apple's curve might look like this today. Let us say tomorrow, again, I'm throwing things out, very hypothetical, just I'm saying, let us say Tesla says, I'm going to buy Apple, or Apple says, I'm going to buy Tesla, or Apple says, we have 3 EVs in line. What will happen? Apple's volatility will expand. So the curve might look very different from the curve we have today. The ranges might change, the standard deviations might change. So the volatility becomes very important in options because volatility increases your premiums. Volatility increases your premiums. Then that is jumping from that. We'll go to.
So, hey, Zen, can I ask you a question real quick on the previous slide?
Yes, Naveen.
How do you use that? So that is, everything that you described makes sense, the standard deviation and kind of the shape of the curve in correlation to the volatility, but what is actionable in that?
So if I am a premium seller, I'm primarily a premium seller, Naveen. I do dabble into buying.
So you sell a put?
I sell, but I prefer to sell when volatility is high. So going back to NVAC's example, look at this example. For $100 stock, they were willing to pay me $18, right? But for a $200 stock in Baba, I paid only $10, right? So the reason they paid me $80 is because NVAX was dropping big that day. There was some news, bad news, and NVAX like dropped big time. So volatility, because if people are either people are panicking or people are jumping in. Either way, volatility is created, right? Everybody is jumping in. I want to buy this. I want to have Tesla. Then volatility increases. Or I want to dump this Tesla. I want to dump PLTR. This thing is not going. Either way, volatility is high. So if you're a premium seller, you are looking for stock. If I sell premium AT&T, I'll get like $1. I'll get like 75 cents. I'm like, okay, is it worth it? I am looking for volatility. Actually, I'm attracted to volatility because I get higher premiums as a premium seller, right? If you are a premium buyer, let us say I want to buy Tesla. I want to buy a Tesla call. If you are like saying, if you are buying a Tesla call on a day when Tesla announces, hey, I'm going to buy Apple as a company and I'm going to get into all sorts of things, then your Tesla calls will be priced much higher than on a no news day. So if you want to buy a Tesla call, you want to buy it when the volatility is low because then it's cheaper for you. But if you want to sell a Tesla call, then you want to do it when the volatility is high.
Yeah. So I think if I put this in swing trading terms, because I think my approach is to figure out how I can use this, in along with the swing trading strategies that I'm already doing, right? But if a stock is within a base, let's just say like cup and curl or whatever, if it's at the bottom of the cup and I see the volume dry out, that would be a good place to actually buy a call. So those are probably the things.
Yes, absolutely. It's coming, Naveen.
Yeah. Okay. No. Go ahead.
Exactly what you're talking. We are going there. We are going, what can we do? Yeah, exactly. It's addressing what can we do today? Like with what we are doing today in swing trading, what can we do? Because if you remember when we had that conversation on your slide, when you showed me the swing setup that you like, remember I told you, Naveen, Naveen, this is exactly what I use, but I sell options here.
Right.
So it all converges. It all converges. So yeah.
All right, go ahead.
But that is a good question. It can be effectively used in swing trading as well. So again, next thing, because we talked about volatility, it's a good segue into Greeks. Okay, again, Greeks is at the first instance when they start speaking delta, gamma, theta, it's kind of like, okay, what are we talking about? Now they are going into, I'm not a mathematician, but this again, this can take much longer if we go into details. So I'm just going to talk through the basics and we can move from there. I also want to address what Naveen talked about, which I'm addressing in further couple of slides. So I'm going to kind of give the basics and go from there. So there are actually many, not just for Greeks. There is also Rho and other Greeks that are related to options. Again, why are we talking in terms of all these mathematical things? Because remember, option prices are derived from mathematical models, right? So that's why all these things get involved. But of all the Greeks, there are 4 Greeks are more important than the other Greeks for options: delta, gamma, theta, and beta. Okay, and the simple way to understand it is delta is nothing but price sensitivity, right? So I'm going to talk a little bit of detail about delta because delta is, some people say there is always contention between which Greek is more important. I really don't know. I really don't want to get into that. But delta is price sensitive. For example, just remember a simple example and that's all you need to know. If delta is 0.6, right? Then for every dollar the stock moves, the option will move by 60 cents. That's it. Just remember that and you're good. So delta is price sensitivity. So remember, an option is a derivative, right? So if Tesla goes up by $1, what will my option go up by? If AMD goes up by $1, how much will my option price change? That's what delta gives. Okay. And then next one is gamma. Gamma is delta sensitivity. And again, whoever is a science major here might remember, is it speed and momentum? Correct me if I'm wrong. I think the speed is the rate of change of speed versus acceleration, right? It's something like that. So delta is price sensitivity, but delta is not static. Speed versus acceleration, right? Gamma is not static. Gamma is the rate of change of delta. So just remember an example that will make it fairly simple. If gamma is 0.2 and delta is 0.4, right? When stock moves $1, remember we said when stock moves $1, if the delta is 0.4, then the option will become, right, increase by 0.4, right? But if there is another factor inside, which is called gamma. If the gamma changes, then the delta itself will increase. So gamma is nothing but delta sensitivity. Again, if you guys are all thinking, should I be looking at everything and decide? To start with, you don't have to know everything. You can start with just looking at some of the basic things. But as you go deeper and deeper, these things will become important. Theta is time sensitivity, because remember we are paying for a right to exercise up to a certain time. If I'm buying a March option, my right is in place only if it's a March 15th option. I have a right only till March 15th, right? And once I hit March 15th, that's it. It's gone. I don't care if I paid $100 or $1,000 or $10,000. If I go March 16th and ask for anything, they will say no, because my option would have completely decayed. So there is a time sensitivity, and I put a time decay chart. So the option value erodes over time, and the rate of erosion increases as you go close to your expiration. Okay. Then the next one is Vega. Vega is volatility sensitivity, which is the rate of change of option price due to change in volatility. Again, just like what we talked about, if the volatility increases, your option price will increase. That's why you will see that sometimes when things get more volatile, the SPACs or the Tesla or even PLTR, you will see, oh my God, sometimes it will be under your strike, but still they will say, if you close now, we will give you a profit or something like that. I'm like, why? Because of volatility. There is a lot of volatility in there. So that is also an important factor. So again, this is as long as you understand the basic meaning, you're good to go. Again, there is a lot of deep dive that people do. There is a lot of good traders, excellent traders who balance all these out and trade with that. That's a journey. But as long as you understand these basics, you are good to go. Then the next one, where can you get started? This is going back to what Naveen talked about. Okay, so yes, there is a ton of things. There is volatility, there is decay, there is all these Greeks. But what can I do right now, right? You can buy puts and calls. You can sell covered calls. I think, let me go through what else I have. Swing trading setups. I'll come to the swing trading setups. You can hedge current positions, right? So now, buying puts and calls. So buying puts and calls, the advantage of buying puts and calls is it's defined risk. You know how much you are spending, right? So if you go back to the first slide, right? I know that out of pocket, I'm spending this much. So AVTR, I buy 2 calls. I know out of my pocket, it's defined. I have spent less than $100 here, $94. And I know that's my spending. I'm not risking any more money than that, right? So just ignore this case where it was exercised, right? If I just look at this one, if you look at the gain, the trade price was 10.73, the market price was 15.45. So I have a $4.72 gain, which is like a $472. If it closed at this point, I made $472. You can also close the call for a profit, right? So I know that I have risked this much and I've made this much. It's a very defined risk. I'm not risking more money. I know exactly how much I am going to lose if things go against me. So that's the advantage of buying puts and calls, right? But what is the downside of buying puts and calls? It has to get in the money by expiration. Else it expires worthless. So for example, and it does happen. It definitely does happen. For example, I have a Apple 155 call for February, let us say. And Apple, let us say, never February 15th expiration. And Apple never gets to 155 by February. Right now it's at 130. If it starts going up a little bit, if it goes to 140, 145, the call value will increase. But let us say Apple decides to tank from here. Apple is struggling at 130. It's going to go to 120, 110, and it's going to waver between 100 and 130 between today and February 15th. So my call will never get in the money. And I will lose if I put $200 on it or $200 on it. How much ever I put in, that call will expire. Remember theta decay, right? The theta decay gets faster and faster. So as I get close to February 15th, that April call, nobody will be willing to buy that call from me, right? Every transaction is a buyer and a seller. Nobody wants that call because, hey, Apple is hovering at 100. I don't want your call because it's 100. Your call is 155. So whatever I paid for that call will go waste. So that is the disadvantage of buying puts and calls. It has to get in the money by expiration, else it will expire worthless. You can take a loss. You can even exit earlier. You can say I paid $400. Now I'm down 300. I'll take the $300 loss. Or you can wait till expiration. You can lose the entire $400. But your loss is defined. You know how much you're going to lose. Then selling covered calls. So can reduce the cost basis of existing and new positions. So this is what again goes back to Naveen, what we talked about right now. So I just decided to have space in my long-term portfolio. I said, I'm going to buy space. I don't mind owning space for the next year and a half, right? So I have 100 shares. And cost basis, I think, was 25.21. I posted it in the group as well, 25.21. My cost basis was 25.21. So again, space, I don't mind holding space. I want to hold space for a long time. But it's just 100 shares sitting there. I'm like, what am I going to do? Can I reduce my cost basis? So I sold, remember, selling premium, right? I sold a 30 call. So 30 call, if it goes above 30, somebody will take it away from me for 30. I'm like, I don't mind because I bought it for $25, which is $2,500, right? $2,521 investment. I bought it for $25. If you take it away from me for $30, that's okay because I made $500. I'm like, that's fine. But in that selling call process, I get a premium of $1.21, right? So my cost basis, look at my cost basis. What happened to my cost basis? My cost basis comes down from $25.21 to $24. So now I own space at an average cost of only $24. If they take it away from me for $30, I make $600 because my cost basis is only 24. I'm like, fine, you can take it away from me. But if by January 15th, if space does not hit 30, I get to keep this. And I can sell call again, right? So this is called a covered call. You already have a 1 lot share. How many other lots you have? You're selling covered calls against it. That's called a covered call. So this is something you can do in swing trading, right? You have it. You are waiting for that price to go up, but in the meantime, you can cut your cost basis. Okay. Then the next one. Swing trading long setups, buy calls or puts. Okay. Swing trading, this goes to, okay, you see a cup and handle, you really like it. For example, SRNE, Friday was a great cup and handle. I completely missed it. It has already moved. But you think SRNE is going to hit 12, 13. Right now, SRNE is only at $8. But you really don't want to risk putting, you want to have 1,000 shares or 100 shares. Depends how much you have a share. Depends on a capital. Small capital, large capital, doesn't matter, right? But you want to actually be in SRNE, you think it's going to go to a 13 in 1 month. Right now it's 8, but you don't want to commit the capital. Instead of committing the capital, so I'm just trying to see if they have an example. Instead of committing the capital and buying the shares, you can just buy a call and you can hold it. Let me go back to Baba. I think that's or AVTR, right? AVTR. If I bought 200 shares, I would have almost put $5,000 to $5,600 in this trade, right? But I want to have a chance. It's like a probability, right? So I just put less than $100 in this by buying 2 calls. So instead of locking up my capital, $5,600, by buying 200 shares of AVTR, I just buy 2 calls and I wait. So I could have done the same thing for SRNE. When the SRNE was at 8, I could have bought just 2 calls and reduced my investment. Again, the risk is always, again, there is no risk, no reward without risk. The risk is always that SRNE doesn't go above and the call just loses value and you lose the money, but it's a fixed risk, right? So you can use options with much less capital, right? And again, this comes with assignment risk. You can also swing trade short setups. Again, before I want to actually basically touch on 2 important things, a couple of important things. I want to go through this quick, so this I can actually let me, while in this slide, I want to say something important here. Start small and because we understand that premium selling and buying and especially selling has a lot of good opportunity. It is better to jump in after you have a little bit of experience and also you understand the risks. For example, selling a put or buying a call in something like Riot or Mara or STC is very different from selling a put or a call in Tesla or Amazon. So be always aware of your capital availability and how much capital is at risk. And this comes from a very personal example. So when I started doing options, I was, again, I was learning on my own. I started doing Amazon iron corners. And again, these are just fancy names for different ways that puts and calls are bought and sold and put together. We can go into it later, but for an introductory course, it's not needed. But what happened is Amazon was going up and up and up. And then I closed the call side and my put spreads were making a lot of money. I was doing put spreads and then I increased the number of contracts. And at one point I was having 5 put spreads of Amazon, 5 put spreads in Google, 5 put spreads in Priceline, all 4-digit stocks, right? And one fine day, I think the market took a dip. I think it was like a 10-point dip or something like that. But that 10-point dip was enough for me to get assigned on 3 of those. So just take one example, 5 times 5 contracts of Amazon, right? 5 times 100 shares, 500 shares times Amazon. Amazon was around 3,000 at the time, or maybe 2,000, whatever it is. So think about the capital, extent of capital, right? So I got a margin call of about $315,000 on my birthday. Luckily, I had spreads. So everything I was doing had a spread. So there was an opposite side. So the width of my spread was only like $10. So it was only $1,000 a piece. So I had already made significant profits. So I survived. And, without big scars. But the reason I'm giving you this example is when you are doing options, always be conscious of your capital. How much capital is at risk? How much capital do I have? Worst come case, if I get assigned on this, either long or short of 100 shares, Can I manage it? Do I have the capital? So have that in mind. I want to finish this presentation with that point because that is one thing as a newbie to options you should keep in mind, you should be aware of. Nothing to be afraid of, but that's something that you should always have in your mind. If you get assigned, do I have the capital? Can I manage it? Okay, is the risk within my parameters? If you manage that, then options give you a lot of flexibility. Again, this is just an intro, basic concepts. There is a lot more. You will see, like I said, you will see credit spreads, debit spreads, put spreads, call spreads, iron condors, jade wizards, all of them. But this presentation should give you the basics, the building blocks. I think that should give you guys a good start. Good luck if you're getting into options. I hope you have an interesting ride. Let me know any questions.
Hey,
Yes, Dennis, people can
just a
paper
quick
trade
question
options.
on the.
Yes, Naveen.
So going back to our example that we were discussing, right? So if you are maybe buying a call with a swing setup in mind,
Yeah.
what is the time frame? Because that is always another challenge with options, which is what are, going back to the Greeks. I guess what do you look for? What is you can buy an option for 2 weeks out or 1 month out or 3 months out. I'm trying to figure out. Usually the swing setups that we have in mind last anywhere from a few days to a couple of weeks or 3 weeks or whatever, right? So
yeah. So Naveen, that's I would say whatever swing time frame you have in mind, use the same time frame. There are also weekly options available. For many of the liquid underlines. Not all underlines will have weekly options. The liquid underlines will have weekly options. But I have found that in the case of options, the somewhat of the longer time frame is better. And it's a very, there are several nuances. Like I don't mind buying February call options now, but I know some traders who said it's too early to buy February call options now. They would rather buy it a couple of weeks before. Like, for example, I already have bought April call options, but a couple of traders I talked to, they said it's a little early for April travel. But I would say to your question, whatever time frame you have for your swing trading, give almost the same or slightly extended time frame for buying calls.
Yeah.
And check the liquidity. That's a big deal. For example, if you go into something like QS, certain strike liquidity varies between strikes also. Some strikes are more liquid. You will see in the open interest. Some strikes are not that liquid. If you go in a strike with the higher liquidity, the chances of you being able to sell the option is much higher. So there are a couple of things like that, but you can kind of wiggle around and find one that you think is comfortable.
Yeah. Okay, that's helpful.
Yeah.
Thanks for the presentation. It was very helpful. I think certainly something I want to try out. I think in using options as a part of swing setups. So thanks.
Yeah, that's great. You're welcome, David, anytime. Dennis, I'm seeing some questions. Yes, people can paper trade options. Absolutely doable. It's doable in TD. In my broker, Tastyworks does not allow paper trading, but it's doable. I know it's doable in paper trading in TD Ameritrade. And a Pdt rule, yes, if you want to be in and out more than yes, Pdt rule does apply 3-4 times. You know how the Pdt rules like 5 trades or 3 trades, that definitely applies to options as well. They won't let you do like 10 trades if you have 5,000 things. It does apply. Can you go into true wall, implied wall, and IV rank? Yes, I can. So true volatility, implied volatility. So I'm majority premium seller. So I'll explain it from that viewpoint, but the concept is the same. So for example, to speak not in fancy term, but basic terms, implied volatility is, let us say an expectation in 1 month is to Tesla to swing between 400 to 1500 or 2000, right? That is what is the implied vol. That is the implied volatility. That's the expectation. That's what is built into the options pricing model. Let us think of it that way. So that is what is built into the option pricing model today to come up with the option prices. But in reality, let us say Tesla swings only between 600 to 1200, right? So they expected Tesla from today to February 15 to swing between 400 to 1500. But in reality, Tesla moved only between 600 to 1000. So that is your difference between implied volatility and actual volatility, right? So as a premium seller, I'm actually looking for higher implied volatility. Oh, great. Tesla can drop to 400. Tesla can go to 1400. They will give me more premium. But Tesla doesn't move that much. The premium will be less. So I can keep my premium. I can buy it back for cheaper. That is what's implied volatility versus actual volatility. And what is IV rank? IV rank is where is the volatility of that particular underlying in a 52-week range. That's what's known as IV rank. So for example, AT&T typically has very low IV rank. It moves only like 50 cents max a day. So its IV rank is probably, I think it's usually in the 30% IV rank. So it will be like the whole year, it's only like 30% or something like that. Let us say there is tomorrow, AT&T comes and says, oh, we are getting into 5G. We are going to be the leader of 5G. We have all the infrastructure in place. We are going full scale. We are top notch already. We have everything laid out. Then AT&T volatility will increase, right? So AT&T, which used to move only 50 cents a day, let us say it moves $5 next week. So that IV rank will no longer be 30%, no longer be 30. It will be 60, 70, right? Because relative to the average 52 weeks this year, the $5 move is humongous. It has moved much more. So that is IV rank. So next week after that announcement, if you look at the AT&T, the IV rank will be 60%, 70%, because it has moved much more than its average move. That is IV. Then what else? What else question? How to handle in swing trade setup? How to select strike price? So this is very subjective. So one help you can look at is the standard deviation curve. I showed you, right? So it showed you. It tells you. And another thing is the delta. That is one more thing. I'll go back quickly. Show. I know we are almost at the top of the hour, so let me show you the right one. Okay, so the delta. So for example, there's something called delta here on the right hand side. It shows you the lower the delta, the lower the probability that it will get there, which goes back to the curve, right? Which goes back to the standard deviation curve. It's nothing but the standard deviation curve. So the strike, if you choose a strike price within one standard deviation, the probability of it hitting is very high. Choose a strike within 2 standard deviations, the probability is low. And options are also priced like that. So it's a little bit of an art and a science. So you pick a strike where you think it will go. So it also depends on what you believe in the stock, what news information you think it's going to. It's a little bit of what all of us traders have the issue, like how much can you predict the future? So it's a little bit of art and science. You look at the standard deviations, you look at the deltas, and you pick a strike that you think is feasible. How to handle the largest spread in bid and ask? This is one of the things, again, just like we do stock trading. If you take AMD, the bid and ask will be very close. But if you take something like QS, the bid and ask will be very wide. So the way I don't know how we effectively can handle, but one thing you can do is you can actually put an order at a price you want and you wait. Sometimes you get filled. So you ask for the price that you want and you wait for the fill. That is one way to handle the wide spreads. Then I have another question on, do you have any options book recommendations for beginner? I actually personally have not read any book. I do have a couple of books in mind, but a lot of information is online. There is a website called tastytrade.com, which is like associated with my broker Tastyworks, tastytrade.com. I will type it here. So that has a lot of very short snippet videos that you can watch. So I'm pretty sure there are a ton of option books as well, but a lot of information is available online. It's not in one place, but you can find anything that you're looking for. So in your strategy, what delta do you aim for when selling premium and what time frame? Okay, so my typical strategy, like I am majority premium seller. Now I am getting into premium buying a lot more than I used to. As a premium seller, I sell 30 delta for starters. Nowadays I sell 16 delta as well, because I talk to different options traders. Everybody has a different philosophy. So I respect all the traders that I learn from. So I try others strategies as well to see how much it can work. But my standard is 30 delta. Nowadays I do 16 delta as well. My time frame is typically 45 days. Again, like I said, I respect a lot of traders. So nowadays I am trying some weeklies and bi-weeklies, but my standard is 30 delta and 45 days premium. All right, any other questions? Thank you. I think
no more
we are over time, so.
I think Ran had a question earlier.
Ran has a question. All right, Ran had a question. We should handle it. Let me see. I know Ran is in the presentations quite a bit. Ran, did you have a question? You might not be here, I think.
No, I'm all good.
Hey, Ran, did you have any questions?
No, I'm all good.
Okay.
Thanks.
All right. All right.
Well, Zen, thank you so much for the presentation. It was amazing. You pretty much covered all the bases. We really appreciate you.
So thank you, guys. Thank you, everyone. Thank you, Dennis, Rapid, you, and Naveen, and everybody. I appreciate the group truly, and I'm happy to be here.
Thank you, Zen, and have a good day, guys. Bye.
Have a good day, guys.